Class, good morning. And welcome to uh, the tuition or the tutorial on master budget. So yesterday after our class, I checked the video very long, so I decided to break it down for you. And so we have master budget, how to do the master budget. So master budget. All right. So, and we explained that the master budget is actually a comprehensive financial plan. We've done the functional budget, and this one is just a comprehensive plan that consolidates all the functional budgets that you did, all right, within an organization. And so it therefore provides an overview of how the expected financial activities are going to be. And we have three major categorization or things to do under the master budget. We have the cash budget. We have the budgeted income statement. Then we have the budgeted balance sheet or budgeted statement of financial position. Okay. All right. Now, my focus will be on the cash budget. All right. So what is the cash budget all about? So we want to know how much we will be spending and how much we will be receiving in terms of the sales. So how much we will be spending and how much we will be receiving. But the focus is that the thing should be a cash flow. So non-cash flows are excluded. So of course, so here what you'll be looking at is that let's find out how much cash will be flowing into the entity. So the inflows and the outflows. Now, when we are able to deal with that, the balance that we are going to get out of that will be our cash balances. So that every period we know how much cash balance we have. All right. Now, if you have done financial reporting or corporate reporting before, you realize that to be doing a cash budget is similar to your IAS 7 statement of cash flow. Just similar, because we are interested in cash item. All right, cash items. All right. Of course, this one will summarize all your revenue. And when we say revenue, revenue can be cash, revenue can be on credit. All right. So that is what it looks at. And checks it against expenses to end you up to obtain your profit. So that is how this one is. And this one will help you to know your position in the industry or the position of the entity by getting the assets and equating it to your equity and liabilities. So basically that is that. But this one focuses on cash. All right. So basically that is that. So you see that when we talk about cash budget, therefore, the focus is, as you see, the cash budget is a cash forecast. All right. So, and it is an estimate of your cash receipt and your cash payment for the future period. All right. Under the existing condition. So the cash budget, therefore, is a commitment to a plan. So how you are going to take care of your cash receipt and your cash payment, so that at the end of the day, we will know how much the entity is having as cash. So we use the cash budget to integrate operating or functional budget. All right, to also assess how much it's going to be, so that we can plan for our cash shortages and also know if we have cash surpluses. Then later compare with what our actual spending and our actual inflow. All right. So how do we prepare the cash budget? You need the receipt and payment side, and that is the most important thing. All right, so the format looks something like this, but I'm going to expand this more for you. All right, so because we are looking at everything cash. So if you look at it, let's say you have your months. Let me push this one here. So you have your months. So we have like month 1, month 2, month 3, month 4. It can be quarterly, it can be yearly, all right? Then you bring, so here we'll spell out the details. So you bring, as you see, we have our receipts. That this receipts that you see there, all right, is receipt from debtors or receivable. So that is that. But it is good you would draft a schedule of receipts to be able to bring these figures in. So you do a schedule of the receipt and you bring this one in. The schedule of the receipt is based on the question, how it is going to be. So I'll take a question we did yesterday, then I will use it to analyze it for you. So you bring a schedule of your receipts, then you slash it there. But apart from the receipt from debtors, you may be having some other receipts, all right? And interestingly, when you are doing your receipt schedule, so let me just give you a simple sample of the receipt schedule. There are certain things you need to watch out for when you are doing your receipt. So when you are doing your receipt, remember, it is coming from the debtors. It is coming from the debtors. So since it is coming from the debtors, you do payment or receipt schedule, or you can say that payment from by debtors. So receipt schedule. All right, but this receipt schedule, don't forget, is from the debtors. We are talking about receipts from debtors schedule. So if you have something like your month 1, month 2, month 3, month 4, the issues here are that check the amount. All right, and also check the timing. It's very, very important. Amount and timing. Check the amount, check the timing. All right, so take note of that. Let me write it somewhere here. When you are doing this, please check the amount and check the timing. Because, for example, the receipt is coming from your sales budget. So you know what you sold, your sales budget. The question can say that the sales are made up of cash sales. So if it is cash sales, we collect the monies immediately. You know that, you and I know that if it is cash sales, we collect the money immediately. But when it is credit sales, be mindful. So the question can say 50% of the money is collected in the month. So you will do 50% of the money. Then the remaining 50%, the question can even tell you that there is 20% that will be collected the next month. So you use the English in the question to analyze that. All right. So use the English in the question to analyze that. But bear in mind, if a credit sale is done, normally the entity can give a discount. So you can less cash discount. What is cash discount? Cash discount is a discount that you give to somebody so that the person can pay faster. All right. So if you give cash discount, wherever the positioning of the cash discount will be, please endeavor to deduct the cash discount. Endeavor to deduct that. All right. Now, another thing that can come about your receivable is something that we call bad debt. Bad debt. Now, if there is bad debt in a receivable, what you have to do is that even before you set the cash sales or the credit sales receipts up, you will have to subtract the bad debt before you do that. So let's say you sell something to somebody that is 10,000 and you are told that bad debt is, let's say, 500. Then it means that the amount to actually collect, even from the point of sale of the the credit sale is actually 9,500. And so this is what you focus on. However, if the question now tells you that when they did the sale, the bad debt happened 3 months after the date of sale, 4 months after the date of sale, then you know if the sale is in period 1, you have to count 1, 2, 3 and put the bad debt there. So everything about budget depends on what the question is actually saying. All right. So there is no fixed way of doing it. It depends on what the question is actually saying. So just make sure that if there is bad debt, you will, depending on how it is, it's either you subtract it before you do the distribution here, or if the question said that every debt that is 60 days due, that is like after 2 months, right? Okay, so if it is 60 days, like every debt that crosses 60 days, that will be after 2 months, is recommended as bad debt. Then it means that if you are to collect the first 30 days in the first month, you collect, second, you collect, but the remaining from the one that continues after the 60 days, that one be a bad debt. All right, so you have to check the questions, the way the question says it. All right, so that is that. So when you are able to do that, you get from your cash, all right, receipt, and we are going to see how you arrange it. So you get your total here, and these total are the ones that you are picking to come and put in the receipt from the debtors. So that is what you do. All right, now, and like I said, the two things you have to do is the amount and the timing. So check the timing very well. All right, so check it very well. Now, after that, there are some form of receipt. So if you see, I say few lines, and those few lines can come from the fact that you took loans, and if you took a loan, it is an inflow, you have to put it under the respective time of the loan. So here, if this one where you bring your total is like this, the loan, when was it taken? Was it period 1? Was it period 2? Was it period 3? Wherever the loan is meant to be, then you put it there. So basically, that is that. Then apart from that, what else can you do? You can sell your asset, disposal of assets. So the period that you sell the asset, you put it there. All right. So here we call it the proceeds from disposal. What you will get from selling. Sometimes be careful. It is coming from the residual value or the scrap value. That is what they sell to get. So basically, that is what you will do. You bring them in. All right. Is that the only thing that can bring money into your business? No, you can get investment income. Let's say you invested money, the people have been paying you the interest, you can put it there. Or let's say the entity has a building, they give it out for rent. Any other money that is coming, you have to bring it in. Is that okay? So bring that one in. Again, you may even take, some people may even bring money into the business by introducing in equity shares. All right. So when they buy shares, they give you money. All right. So when they introduce in equity capital, that one too is a cash flow that you can get. All right. So look at the question well, look at it and find out where the monies are coming from and put it in their respective places. It's really not exhaustible. So these are the advice that I have for you. Okay. So here, the timing of the cash receipt is very important. All right. So take note of that. This is even the cash flow forecast. All right. So the things that I've said here. And please, the thing is that, so make sure that you read the question and the timing that comes with the question. All right. So basically, that is that. That is that. Now, there are other places for the outflow. So I think I've exhausted the space here. I'll try and create some for you. So let me try and create some here. Marker is freezing, right? So the marker is misbehaving. Let's just wait a little while. Good. So the explanation that I've done here think you saw it, so that one shouldn't be a problem. All right, so apart from that, there are payments too that you make. So when you finish adding everything, in case they were all present, but I'm not saying it is always present. So please, what you do there depends on the question. Budget is just a test of your English language. That is what it's about. It's just a test of your English language. So you total everything. All right. So total them. We call it your total receipt or total inflow, whichever one that you call it, total receipt or total inflow. Then you come here with your payment. So here we were dealing with inflows. So you can call that in total receipt or total inflows. Then here we come to your outflows, which is your payments. Okay, so your outflows, which is actually your payments. Okay, now that one too, you have to do a payment schedule. All right, and need I say that these things, the cash sales, the credit sales, especially the credit sales, these things will be coming from your sales budget. So if your sales budget is wrong, you may get this one too wrong. So do your sales budget well. And we've done sales budget. Let's check the previous video. You will see how sales budget is. All right. So basically that is that. Then when you come to the payment side, like I'm saying, you do a payment schedule. So payment to suppliers schedule, payment to suppliers. The same thing you did here, and please, payment to suppliers, it will be coming from your purchases budget. Purchases budget. And what do we purchase? We purchase raw materials, all right, from them. So you set up the budget. So if they say 40% of the money is paid in first month, then you do 40% of that sales budget value and put it in first month. If they say the next month 30, all right, you put 30. So this one's first month will be here. The next 30 will be here. Let's say the remaining 30 is also in the next month. You put it like this. And if you are doing the one for month 2, 40% first will be here. The 30% will be here. The next 30% will be here. That's the same thing you do with the cash budget. You do the same for this one and this one. We don't need this period. This one you do the first month only. So that's how you'll be arranging it. Okay, so the same thing, if this one too was like that, you'll be arranging it similar. When we take a question, you will understand what I mean. But apart from the schedule, so you bring your payment schedule. So all the payments, the payment schedule from here, then you put in the totals of the payment schedule. But it is not only raw material that you bought. There are other things that you might pay for. So things like wages and salary, that is the labor part. So that one to check, what does the question say about the timing? Budget is all about the timing. Check it out, all right? So check how the timing said it. You will do that. Fixed overhead expenses, so overheads. So I can group it together and call it production overhead. All right, so just add them. Okay, add everything. There can be dividend paid. There can be purchase of non-current assets. All those things. So purchase of NCA. There can be dividend, and these are the things you normally see. That's why you've seen it here. So all those things you have to add them up. Add them up. I will need to create space for myself, so I might delete certain things down here also. All right, so you add them up. So basically that is that. I think you've seen the schedule, so I can take it off now because I need to create some space. Oh, so just to actually, so let's have them back. Instead of deleting, let me just copy it. Let me just copy it. or better still, cut it. So you let me just place it and come and cut it off. Yeah. So I pasted it here. So you can still have it. But now I can delete here this one from my space. Okay. So basically that is that. So now that I have my outflow, so it can be anything, all right? It can be payment. This time around, you are the one paying the dividends. So payment of dividend, you can be the one paying. You can buy an asset. It depends on the question, all right? So that is that. But one thing you should take note of is depreciation. Depreciation doesn't come to the cash budget. So if there is depreciation included in any of these things, remember to deduct depreciation. So remember that. Okay, remember to deduct depreciation. Okay, so less depreciation wherever it should be, less that, or better to replace it. So normally, when a depreciation is deducted, you see, in budget, what you should see is that if a depreciation, normally in accounting, depreciation is an expense. Depreciation is an expense. All right. So take note of that. And normally, when we are doing cash flow, because they have already deducted the depreciation in cash flow, that's accounting. All right. Because they have already deducted it out of the profit. How do they deduct it out of the profit? They add it to the expenses. They will add it to your expenses. So you will see that when they add it to your expenses, and listen carefully, that's the difference between how we treat depreciation in the accounting IAS 17 and cash budget. In the cash budget, IAS 7.1 cash flow, we start with the profit. Now, if the profit that you see, depreciation has already been deducted, which you shouldn't have because you were doing cash flow, you add it back. But here, depreciation is added to the expense. Maybe your production overhead, because the depreciation of the factory building is added to the production overhead. So if it is absorbed there, we don't want to see it in the cash flow. So it was added to the expense. So in that expense, we need to take it out that expense. We are not taking it out of profit or anything. We are deducting it out of that expense. So if you have such a situation, deduct the depreciation because depreciation is not a cash flow. Similar to provision for anything. Provision, if a provision has been made to anything, you have to ignore it because provision is not an actual thing. We don't use provisions, depreciations in it. So if there is depreciation, please remember to take it out. All right. So if it's a separate schedule you are doing and you take it out there, fine, but you can also take it out from here. So get your figures. Get your figures. This is your total inflow, outflow. And when you are done, what you will do is that, look at it very well. I'm going to subtract this figure from the one that I have here. So subtract them. When you subtract them, whatever you get, you put it here. We call it the net cash flow. Net cash flow. All right. Now, if you're able to get your net cash flow, the next thing that you should do then is to add your opening cash balance. Opening balance of cash. All right. So when you add your opening balance of cash to it, you will get your closing balance of cash. So like you see here, closing balance of cash. So that is what you do. That is what you do. Now, the thing is that the question doesn't need to give you the opening balance of each year. It just has to give you one for this first month or whatever it is, because the closing balance of one period is equal to the opening balance of another period. So that is that. That's why I tell you that if you say you are going to send your last on 31st, 1st January, you are the same. All right. So these are the advice that we have for you. All right. So that is that. So like I said, check the value of the receipt and how much will be received from the credit sale. The timing of the receipt, when would the cash be received from the credit sale? So be careful about that. All right. Just be careful. Now, you see the way I set this one up, that these are the sales amount. And they said that 10% will be in the first month. All right. 10%. It says that all the sales are on credit and follow this pattern. In the month of sale, you get 10%. Then in the month after the sale, 40%. 2 months after the sale, then the organization expect a rate of irrecoverable debt to be 5%. So if you take this particular amount and 5% will be bad debt, so that it means that we will get only 95% of the money. Is that not it? You get only 5% of the money. That means that the balance you get is 5,700. So it means you get 0.95 out of the 6,000. So that is what I was trying to explain to you. So you get 5,700. So what you are going to use to do the distribution should be the 5,700. So you do what you'll be doing is that so this one you see is the last month own, right? You said in the month of sale. So if you pick any of the months, so like the month of April, that is in its own month, that is how much will be derived. But you have to do the 10%. So if you check this one, we have this 5,700. So out of this 5,700, how much will be collected in the month of that particular sale? Because every sale that happens, you get. So this is how you can do this one. And so like this one to February, whatever figure that you have. So according to this question, we are supposed to do it for only the April one. All right, only the April one. So if you check the April, so it says that in the month of April, we are told that if you pick this January, so the question said April, so you focus only on April. If you pick this January, okay, the money that you can get, so in the first month is 10. So the first month is January, 10, but we are not asked to do the first month January. The next month you will get, it says that, so this is it, month after sales, you will get 40%. So that one too, the same 40% of the value, that is that. In the month of, and it says that 2 months after, they will pay the 45%. So if you look at the sales that is happening in January, in the month of sale is this, that's the January, you get 10%. I don't want to do that because that is not the requirement of the question. But if, let's say we are setting it all up, so let's just use that one as an example where there is bad debt. So we have January, February, March, and April. Good. These sales that happened, so we are doing the cash receipts, the cash receipt. The sales, we are told that it is 6,000. And this one is 8,000, 4,000, 5,000. You could clearly see that we are told that in the month of sales, we will get 10% of the amount. A month after, 40%. Okay. Then the month after, so you clearly see that the 5% has already been captured for you. So like I told you, you are going to do just 95%, but the 95% has been done for you. You can clearly see that. See, this is 45, 40, that is 85, then this. All right, you can clearly see 5% is already gone. So it means the 5% is foolish case. But assuming that this percentage summed up to 100, and the question still told you that there is 5% bad debt, then it means you first do the bad debt out and share with the remaining. So that is what you would do. But this one, you can see clearly that you have only 95% already set up for you. So the question is basically telling you that the remaining 5% is foolish case, is bad debt. So if we pick the sales that happen in January, will we have a figure of that sales in February? Think about it. Because if you pay 10% in January, 40% in February, then 2 months after the sale will be January, to be February and March. You won't get anything of that particular one in April. So that is dead. But if we come to this particular one, 10% will be paid in February, 40% in March, 45% of that figure. So you do 45%. So you can say, you can write it like this. First month sale, first month of sale. If we are doing everything, ignoring this one. But if you want to solve the question, we have to solve the question. It means from April, we won't get anything from the January sales. So if you want to check it, you only do January. So if I want to do the question as if there is nothing here, we are not focusing on April, I'll do 10% of this, which will be 600, right? 10% of this, that is 600. That is what I'll have. Then 40% of that, because bad debt has already been factored in, that's why I'm using the full percentage. So 10% in the month of sales. 10% in the month of sales. 40% month after. So you'll be writing those things. 45% 2 months after. So if you pick the January sales, that is how it will be. So 10% of that gives you this. 0.45% of that 6,000. It gives you 2,700. That is the next month. Then 0.4, oh no, the first one, what was that? 0.40 by the 6,000. That's 2,400 rather. Then this one will rather be the 2,700. You will check that there's an element that is missing, and it was bad that we couldn't collect the 5%. But when you are doing for February sales, okay, you can have a value of it in a value of the February sales in April, because 2 months time 45% will be there, and that is what you see here. That is what you see here. So the first month, for example, in February, how much will you get? If you check, it will be 10%. So in February, you have 800. In the next one, you do 0.4, 40% of that 8,000. And you are getting 3,200. So this is what I was trying to show you. So let me show it to you like this. Yeah, so this was what I was trying to show you earlier. So let me show it to you well. So this figure will come down. Oh my goodness. So it will come down like this, 2,400. Then this one will be here. That's where it will be. Good. So this is what I was trying to show you. And we know that this one, we don't get anything from that. So when you are doing the first one, it will be like this, 800. See where I put it, 800, that's the 10%. Then the 3,200 is its second month. That is where I put it. Then the 4.5%, 45% of that one, which is 3,600, will come to its position in this place. So 45% will be, I think this thing should be here, because this is what we don't need to put the dash there. So you see it goes like this. You've done this, you've done this. Then here you have 3,600. So this is what I was trying to show you. So we will be focusing on the total for April. Then when you come to March, 10% in March is how much? 400. 40% of that, so 0.4 by 4,000, that gives me 1,600, of course. So this is it. But I won't do the 45% one because it is outside the scope of my budget that I'm doing. So that is that. Then this one will be 10% of that particular one. So that is it. So this is how it will be. So now if you total your April figure, you could clearly see it. And that is what you see here. And so this is how you do the schedule for each one of them. All right. So basically, this is how you go about it. Now, so the issue about the bad debt, you see the way the bad debt is stated. So it means that you see 95% has been done already. But if it were 100%, let's say bad debt, so here was, let's say 15. So it is 15, 40, 45. Total will be 100. And so if bad debt is 5%, I will do 5% of this money out. So meaning that I will do 95%. So that one will give me 5,700. So 95% of 6,000. Then I now come and use my percentages to do the splitting. All right. So that is what we are talking about. That is it. So you basically go about it. So ladies and gentlemen, this is it. You do same for the payments for the suppliers, and that is that. Now let's quickly use your past question, your exam past question to solve it, and you'll be done. So now this is it. What we did yesterday. We did a sample of this yesterday. So now this is it. Now the question says that you Babu Limited as a business and deals with the production of ketchups for sale. The company has been in this for the past 2 years. All these things are information for nothing. Expect to have sales for the next 6 months in 2019. Expected sales for each month for the first 3 months is 15,000. Then it continues from 24,000. All right, for the remaining period. So that is the sales in units. Due to the recent demand in the product, it is believed that it can sell the thing for 50 cedis. So you know your sales budget, you need the unit multiplied by the price. So that is what you get for the first 4 years, and increase its price further by 10%. So look at the way it is further by 10%. So it means that after the 4th month, it will increase it by 10%. Now it is just 10% thereafter. So it's like you have to be careful. Sometimes the 10% will be cumulative. So maybe the 4th year is 10% of the 5th year is 10% of the 4th year increment. Then 6th year will also be 10% of the 5th year increment, depending on the question says it. But this one, it is clear that it is basically saying that you have a 10%, it increased 10% thereafter. So that 10% cannot be assumed to be a yearly 10%. So you have to be very, very careful about how the question puts it. All right. So those are the dangers there. So if they tell you that every year it will be increasing 10% every year of the previous amount, then you check your previous amount to do it. So that is it. Okay. All right. So that's it. Then we have other payments that has to be done. So tying it to the production unit, material is this is here, this one too is here. All right, wages will be paid as they are incurred. So that is that, incurred. So it will be paid as they are. And the production overhead are paid for a month later. So that one too should move 1 month ahead. Suppliers allow a credit of 50% of each month purchase. So if you purchase 100,000, that first month you pay 50,000. Then the following month you pay the 50,000. Customers are expected to pay for goods sold to them in the following terms. So 40% in the month of sale, like the way we did what we just did. 30% in the second month, the remaining amount on the following month. So that's 3 months period they are using to pay. It says that the inventory policy of the firm in relation to finished goods are as follows. So the stock of finished goods at the end of each month is 15%. So you will do that. Then the planned sale for the month whereas output is constant. All right, so that is the statement there. Output is constant means that whatever they produce is the raw material they will go and buy for to come in. So your production unit, if your production is 10,000 units, they will go and buy exactly that 10,000 units to come and produce. That is the meaning of output is constant. Oh, sorry, input is constant. So if your production budget is 14,000, they will go and buy materials for 14,000 and come and use. So basically that is that. Another meaning of output is constant also means that the product they have at their opening balance is the same product they will keep at the closing balance. The same product. So its opening balance of the product will be equal to the closing balance of the product. And the question is that the constant input is 3,000 units. So it means if opening balance of the unit is 3,000 of raw material, the closing balance is also what? 3,000. So it knocks off itself, all right? But because it is exams and sometimes takes a mark, you may have to bring in the 3,000 and also exclude the 3,000. If you are not bringing it in, then it means that you must make a note, a statement as to why you are not bringing it in. All right, so that is that. Sales are evenly spread throughout the month, and depreciation expenses 2 cedis per unit included in the production cost. So it means that it has been included, and you will do the amount and subtract it from it. So we are told to do sales budget. So let's do our sales budget. Sales budget. All right. So what do? We set up our month. Okay. So you can say everything will be in cedis 300, or you just say it will be in cedis. All right. The figures there will be in cedis. So you have how many months? 6 months. So month 1, month 2. So you can write the months. Okay. So you say months. Month 1. Month 1. Month 2. Month 3. 4. 5. Then 6. Okay, so let me do it like this so that I can have enough space for that. Good. So our sales unit, you bring your sales in units. Okay, so month 1. So you don't have to really put the 00s up the top or the CD sign there. Month 1. So we are told that the sales unit, this is how it's going to be. For the first 3 months, it is 15,000 units. So you write 15,000 units. It is in units. Don't forget that. That's the first 3 months. Then it says that and 24,000 each month of the remaining period. So here will be 24,000, 24,000, 24,000. So set it up like that. Good. Then what is the price? So the selling price per unit. The selling price per unit, we are told it's 50. So here is 50 here for the first 4 months, 50, 50, 50. Then it will increase by 10%. So if you multiply 1.1, that's increment of 10% by 50, you are getting 55. So basically, that is that. So that is what you put there. All right. So that is what you do, then you move. Okay. So now, what will be the sales figures that we have in terms of what we've just projected? So what you will do is that you just multiply it, because sales amount multiplied by the unit gives you your sales in value. So you just write sale in value. So sales in value. And if it is Ghana cedis, just let us know it is Ghana cedis. All right. So now, when you multiply each and every one of them, when you multiply each and every one of them here, you get your total. Okay. So by multiplying each one here, this is 750. 750,000. 750,000. 750,000. Then this side is 1.2 Then this gives 1320,000. 1320,000. So basically, that is how it will be. So you are done with your sales budget. You do this according to the exam. You have 4 marks free of charge. All right. But the 4 marks, this is how it is marked. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. We don't need this. All right. So, but you have to do it. So the 12 will be multiplied by 0.3 or something so that you get your 4. All right. So that is how it is. So I production budget. Now, what is production budget? So if you check the template that I have been giving you since I started teaching budget, this is the template. What goes into production budget? So this is it. So this is it. Production budget includes the raw material you buy, the labor, and the factory overhead. That makes up the production budget. And it is the same thing that makes your cost of goods sold, all right, in the P&L, all right? So take note of that. So production budget, therefore, we will need the raw materials. And if you need how to do the raw materials, involve your production budget itself. So how do we start the production budget? So month 1, month 2, up to, so 1, 2, 3, 4, 5, and 6. We will need the sales unit. Is that not it? The sales in units. And the sales in units, we have it already to be 15,000, 15,000, 15,000, 24, 24, 24. All right. Then we will add what? Closing stock of inventory. So closing stock or closing inventory. How do we find our closing inventory? When you come down the line here, we were told how to find closing inventory. So closing inventory of finished goods is 15% of the planned sales for that month. What is the planned sale for this month? This is it. So you are going to do 15% of that. So 15% of 15,000, 0.15 of 15,000. That gives me 2250. So 2250. This one too, the same thing, 2250. 2250. Then this one changes. So you have to also effect the change. All right. So if you do 15%, 0.15 of 24, that gives you 3,600. So 3,600, 3,600, 3,600. So a question can say the closing stock is 10% of the previous month. So that's how it will be, 10% of the previous month. So you just follow the English of the question. So that is how it works. The question told you that the expected opening stock of finished goods is 2,500 for this first period. So opening stock, you less opening stock. All right, opening stock is, this one is 2,500. We are lessing. All right, but it is fine not to put in the bracket sometimes because the word less is used here. It makes your work gentle. Okay, so what will you get? And please remember, closing stock of one period is equal to the opening stock of the other. We've kept saying that thing. So the closing stock for this period will be what? 2250. Is that not it? 2250. This one, 2250. This one, 2250. This here will be 3,600. Is that not it? And this one here to be what? 3,600. We are not interested in the 7th month, so we won't go there. So this is it. So you get your balances down. All right. When you check the balances, here will be 14,750. And next is 15,000 because it cancels out itself. This time to 15,000. This side too will be what you gave me was 25,350. All right, that's what you gave me. Then the next one too is 24,000. That is the production in units. In units. So basically, that is what you have in units. All right. Then you need to buy raw materials to do that. Remember, it is the raw material we need. raw material, labor and factory. That is what we need for this one. So what you've done is that you found out that you have to be producing this number of units. That is what you've actually found out. But how are you going to produce it? How much raw material will you need to buy and do the production for that? So you are told that it is constant. It is constant means that you will be buying exactly this. That is the meaning. You will be buying exactly that quantity. And the question said that the constant input, all right, the constant input were asked that, so this is finished goods. So the constant input is 3,000. Constant input held. Yes, and the one that is held, so if you remember how we do product, what do we call it? Material usage budget. You will need the production unit, you will add the closing stock, and you will less the opening stock. Then you get the production, what we raw material purchase. All right. So that is how we do it. So basically, that is that. And for the question to tell you that it is constant, the opening balance is constant. It means that the opening balance for that would have been 3,000, and the closing balance too would have been 3,000. So something like this. Opening balance. So your product use the raw material budget. You start with this, and you will add the opening balance of 3,000 and less the closing balance of that same 3,000 because it is constant. So because of that, you just have to write a statement. It is the raw material input is constant, and so it is in and out. All right, you can do that. Other than that, you will have to do plus 3,000 minus 3,000, which will give you the same figure here. All right. So if you don't write that statement, you may be losing some ticks because a figure was given to you. So just write that statement somewhere so that you don't lose your tick. Or better still, you can just repeat it. See, this one too, the closing balance will be here, and it is the same thing they begin with. So it will be the same thing. So better put the statement there and be free. Apart from that, so that you get the raw material usage, because you were told that the raw material, which is the direct material, is 15. So constant means that the one that you are going to buy is equal to the production unit. That is the meaning of constant. All right. And the 3,000 they gave you is the opening balance and at the same time the closing balance. So you realize that one will knock off itself. So what the company is actually going to buy is the production unit. And so if that is the case and you have made your assumption, then you bring in the cost per unit. Cost per unit here is 15, 15, 15, 15, 15, 15. So you just multiply that. So the answer you are getting is raw material purchase budget. Raw material purchase budget. And when you multiply, the figures you gave me was 221, 250. You gave me here to be 225,000, 225,000. Then this one was 380, 250. All right. Then the next one is 360,000. 360,000. Easy peasy. That is that. But because, like the graph that I showed you, it doesn't end there. We will need the labor and we will need the overhead. So the labor is given as 10 cedis per unit. But in some other question, you have to go and work it. So wages. So what did they say? It is paid, all right, in the month. All right. So the same month, it is paid in the month. So when you are doing that, the production, you have to add the wages thing. And the wages, it's per the question is 10 cities. Because this is not the cash budget, we are just doing the production budget. We just multiply. So the wages is 10 cities each. So per unit. So I have here 147,500. Here will be 150,000. So that is what we have. 150,000. This one will be 253,500. That's what you have because you are multiplying it by the unit. So this will be 240,000. Here will also be 240,000. So that is that. Then the production overheads. Here too is production. So there is nothing like depreciation. You can add it. All right. So I think it is a repeated practice because that one too is sometimes because of time in the exam, your examiner makes certain things obvious. So you don't have to punch calculator for that one again. So 240. 240. All right. So basically, that is that. So therefore, you can get your total production overheads, production budget. All right. Think that those figures didn't come. And so I will have to put them in. So total them, put them in. So the last one will be 240 multiplied by 2. That is 480. Then I add 360. That gives me 840,000. The same thing here, 840,000. This one is 253 multiplied by 2. 253, 253.5. 500 is part. Multiplied by 2. I get 507. Then I add it to 380.25, right? All right. That gives me 887,250. This 2 is 300. So that makes it 525,000. 300, that makes it 525,000. Then this one I have 147.5 multiplied by 2, that is 295. Then I add 221.25. That gives me 516,250. So this is it. And if you're able to do this, you get what? 10 marks. All right. Now let's do the schedules and come and prepare our cash budget. The question could have easily ignored this one, the schedules, but tell you to prepare cash budget. But that means automatically you have to do it. All right. So sometimes you don't need to be told. You can just put cash budget and put there the whole 16 mark. All right. So let's do the III. All right. So schedule of payment to suppliers. So we have the months. Month 1, 2, 3, 4, 5, and 6. All right. So the schedule, we are looking at the raw materials we purchased. This is what we purchased. All right. And that is the supplier. All right. So we are told that per the schedule, we are told that how are we going to pay? Suppliers allow 50% credit. So meaning that it will be something like this, 50% in month of sale, then the remaining 50% after month of sale. So that is how it is going to be. So if you pick this figure, you are going to do 50% of it in the month, then the remaining 50% goes into the next month. All right. So let's see figures that we have. The payment, 50% of this one was 110, the 110625. Yeah. Then the next one, 110625. This is how we present it. The next one is 50% of this. That is first month 112,500. The remaining 50%, 112,500. All right, so that is it. Then the same thing, I think the value is the same here to 112,500. That is 50% of this. Then the next month, 112,500. The following month is how much? 380. So 380, half of that, you gave me 190, 125, 190, 125. Then 360 was 180. So here will be 180. Then remaining 50%, 180. Then the CTR to 180. We don't do the 7th month because we are not interested in that. So basically, this is what you do, and you get your payments scheduled. So the total here is like this. Then you have this side too. You gave me 221,125. The 223. Yeah, guess it's 223. 223,125. Total here. You gave me 225,000. This one is 302,625. 370,125. Then this one is 360. Okay. So that is that. You do that, you get the 4 marks. The next thing to do is the schedule of receipt. You see, a question can just say prepare a cash budget and put the 30 marks there. But you have to do these things. It doesn't have to tell you to do the schedules before you come to the cash budget. You will have to know that those things have to be done. So schedule of receipts. So 1 and 1, 2, 3, 4, 5. 4, 5, and 6. All right. How was the sales stated? The customers. Customers are expected to pay 40%. So you say 40% in month of sale, 30% second month, remaining following month. So that the remaining will be what? The remaining 30% in third month. So basically that is that. So if you check your sales figure, your sales schedule, so you do 40% of this and put it in the first month. 40% of that same figure will go to the second, 30% of that same figure will go to the second month. Then the third month will have the remaining 30%. So that is what we are doing. So if you do 40% of 750, I was giving the figures. You realize that your first month of 40% will be 300,000. So you can just do 0.4 by 750. You get 300,000. So just put it in there. 300,000. The 30% will give you 225 in the second month. The same thing in the third month, 225. So this one too, it was 750. So 300, 225, 225. The following month was also the same thing, the 750. So 300, 225, 225. Good. That's what you do. Then the next month, I think the figure changed to 1.2. So if you do 40%, was it 1.2? It changed in the fourth year. Yeah, 1.2. So when you do 40% of 1.2, so 0.4 of 1.2, that gives you 480. So that is that, 480. Then 30% for the next is 360. Remaining 30%, 360. Then the next one was 1320. So the first 40% will be 528. The next 30%, 396. Then we don't need the other one. Then the CTR2 is first is 528. We don't need the other one. So balance it and get the marks that are associated with that. So here is 300. Next 525. Next 750. 930. 1.113. Then 124. 1284 and 4,000. So 1284. So that is what you have. 1284. Let me write this clearly for you. 1284. All right. So that is that. The last thing to do is now present everything in your cash budget. So you now prepare your cash budget. So we have month 1, month 2, 3. I think I should space it, right? And we are ending. So I don't really need any figure from the question. Every figure I need now is from my own solution. All right. So the only thing I'll go and pick from the question will be the remaining cash items like your labor and things. But that one, we can pick it from here. All right. So the first thing that you bring will be your receipts from your debtors. Do you remember? Receipts from debtors. Because we are doing the inflows or the receipts. These are our months. All right. And please, when you are doing this, make sure you put the currency sign. All right. Put the currency sign. So all these things that we were doing, just put the currency sign so that you don't lose any mark out of it. Put the currency sign. If the thing is in cedis, put cedis. If it is in units, put units. All right. So this one, we know from what we've done here that here is 300,000, 525. All right. 750, 930, 1113, 1284. So you know everything. You put it in. So check if there is any other thing, like they took some loans, they'll get the money, they collected dividends. If they are all in the question, do it. All right. So that is basically how you go about it. Just do those things. But in this case, we don't have anything like that. So that will be your total. So you just underline it once. If you have other things, you would have added. Then let's bring payment to suppliers from the raw material aspect. And you did that, and it is somewhere here. Yeah, you've seen that. So the totals, I can't. Wow. So just look at them. We are going to write it. All right. So I have here I have here 110625. Next was 223125. The next was 225,000. The next was 302625. Next 370,125. Next is 360,000. So the figures that you had here, that is what I've written. All right. Not only that, you paid wages. So the payment of the wages, okay. Then the payment of the production overheads, you pay them. Then in the production overhead was depreciation. So kindly less depreciation from the production overheads. All right. So when you pick the question back, the question told us that the wages is paid in the same month. And so that is that. Then the production overhead is paid 1 month later. But in each production overhead, there is depreciation. We were told that depreciation is included in each production overhead for 2 cedis per unit. We already know our unit, so we will multiply them. So the wages were somewhere here. You see the wages, it is paid in the same month. So copy and paste. Okay, so that is that, in the same month. So month 1, we are paying, and we have 147,500. Month 2, 150. That is that. Month 3, 150. Month 4, 253, 500. 5, we have 240 and 240. So it's just copy and paste. But the production overheads, you were told that it is 1 month after. Where is production overhead? So it has to be 1 month after. So shift it 1 month after. So production overhead was the same as these ones, but it's just that it is 1 month after. So 147, 500, 147. No, this is 150. So the second one should be 150, no 147. 150. Yeah, that's what you even have here. 150, 253, 500, and here will be 240. But there were depreciations included in these things. Depreciation is 2 cedis per unit. The first unit we had was 17,450, 750, right? 14,750. If you remember, these are the production units. It's inside. So per unit, you have to take it out from these figures. So how much is that? The first one is 29,500. Second one, 30,000. 30,000. The next one, 5,700. The next one, 48,000 units. All right. So that is what is there. So it means this one was 24, and we multiply by 2. So you've taken away your depreciation. Then you can now total all your outflows. All right. So these were the payments and they were your outflows. So the total, quick proco, the net, we call it the net cash flow. This side, if you total, you are getting 258,125. This side is 491,125. This side is 415,000. Next is 676,125. Next is 812,925. We have 792,000. Then you add your opening balance, your opening cash. Opening cash. So the balance brought down. Unfortunately, we don't have any in the first month. So our total will, oh, sorry, we need to subtract first. This one was our total. We need to subtract. need to subtract. So this one is the total. This side is actually the total outflow. These totals that we have done is total outflow. So, and if you remember what I told you, we are going to deduct this thing from this from this from this from this from this, and you get your net cash flow. So when we deduct, rather, we are going to get figures like 41,875. Here will be 33,875. Here will be 255,000. We have 253,875. We have 375. Then we have 492,000. All right. So now opening cash. Opening balance of cash we don't have for this particular one. So our closing balance will therefore be the same as 41,875. Closing balance of one period is equal to the opening balance of the other. I think by now you get that concept. So here will be 41,875. When I add it now, I have 75,750, and that goes here 75,750. All right, then add it here, it gives me 330,750. It goes here 330,750. I add it to this one, that gives me 584,625. So it goes 584,625. Total here is 884,700. Then 884,700. I add it. I have 1,376,700. Ladies and gentlemen, this is our cash budget. So if God blesses you, then you get any of these figure in your first line wrong, all the things you do wrong. But good news for you is that it takes out. So, ladies and gentlemen, this is it. Repeat it for the remaining questions, taking note of the details, and you are fine. So the MBA, MPA, this is it. All right. So we'll meet on Saturday to pick another a question on bank rec to do. A question on cash budget again, where there is budget dynamics. Then we look at ratios. Thank you. See you. Bye-bye.